Hardly a day has gone by in recent months without news of a fresh crackdown on one part of the Chinese economy or another. The slew of announcements of tough new regulations and the stringent enforcement of existing rules have targeted many of the country's biggest companies. In this video, I have brought you the news in detail. Make sure you stick with me till the end. Without any further delay, let's get into it. President Xi Jinping's centerpiece policy initiative, known as Common Prosperity. The phrase is not a new one in China. It has been around since the 1950s, when it was used by the founding leader of the People's Republic of China, Mao Zedong. The sharp escalation of the term's use in the year that the Chinese Communist Party also celebrated its 100th anniversary has been seen as a signal that it is now central to government policy. Key to the Common Prosperity policies is Beijing's attempt to narrow the huge wealth gap between the nation's richest and poorest citizens. It's an issue that some would argue both endangers the rise of the world's second-largest economy and poses an existential threat to the Chinese Communist Party. These latest measures are seen by some as a way to rein in the billionaire owners of some of China's biggest companies to instead give customers and workers more of a say in how firms operate and distribute their earnings. The ramping up of rhetoric from Beijing in recent months has seen action being taken against a dizzying array of Chinese business interests. Everything from insurance agents, private tutoring firms, real estate developers, and even companies planning to sell shares in the US have come under intense scrutiny. The technology industry, in particular, has seen a deluge of action against it, including crackdowns on e-commerce firms, online finance services, social media platforms, gaming companies, cloud computing providers, ride-hailing apps, and cryptocurrency miners and exchanges. These moves are, of course, having a major impact on both China's economy and society, and effects are also being felt all around the world. The country has long been seen as the factory of the world, as well as a major engine of global economic growth. Now, the uncertainty around the regulation of businesses in China is making it difficult for companies from overseas to make decisions about potential investments. Although another way of looking at it is that while there will be some short-term upheaval as the new rules are implemented, the reworked regulatory framework will remove uncertainty in the long term. Presumably, that's the way the Chinese government views it at least. How the crackdown is crushing the mighty ant. Even before it became fully apparent that Mr. Xi was looking to reshape China's economy with his common prosperity policies, Beijing unleashed a shock and awe display of its firepower. Less than a year ago, Jack Ma, the multi-billionaire founder of Alibaba, who was known for his flamboyant appearances at dazzling corporate events, was just about to oversee the world's biggest ever stock market debut. The initial public offering of Ant Group, Alibaba's financial affiliate and owner of China's largest digital payment platform, Alipay, was set to rake in $34.4 billion. It would have made Mr. Ma Asia's richest person, but then he made a controversial speech criticizing China's financial system. Within days of the address, the share sale was called off, and the once high-profile Mr. Ma was not seen again in public until January the following year. Since then, Alibaba has been hit with a record $2.8 billion fine after a probe found that it had abused its market position for years. Ant has also announced a drastic restructuring plan for its business. Whether or not the episode was officially part of the Common Prosperity Initiative, we can leave it to the historians of the future. What we can say for sure is that Mr. Ma's spectacular fall from grace and the action taken against his vast business empire served as a powerful opening act to the drama that is now reaching into every corner of China's economy. China Evergrande Group is another vast company that has found its fate intertwined with common prosperity policies. Its core business is real estate development, but the company also has interests in wealth management, electric cars, and food and drink manufacturing. It even owns one of China's biggest football teams, the Guangzhou FC. It's run by a multi-billionaire, Hui Kaiyan, who, unlike Jack Ma, actually did briefly become Asia's richest person back in 2017, according to Forbes. In recent weeks, the debt crisis engulfing Evergrande has rocked global financial markets. On its way to becoming one of China's biggest real estate developers, it racked up debts more than $300 billion. Beijing now views heavily indebted property firms as a threat to the economy, so Evergrande was exactly the sort of company it had in mind when it introduced measures to cut borrowing in the sector. Now, without enough fresh infusions of borrowed money, the company is struggling to meet the repayments on its existing debts. Under the Common Prosperity Doctrine, authorities seem more likely to help buyers of Evergrande's properties and the customers of its wealth management business rather than the company itself and its other creditors like bondholders and banks. This notion was supported just this week when China's central bank, without directly mentioning Evergrande, vowed to protect consumers exposed to the housing market. That all adds up to a major headache for financial markets, as the firm has seen more than 80% wiped off of its stock market value in just the last 6 months. The Beijing crackdown also became a boss battle for gaming when in early August, a Chinese state media outlet called online games spiritual opium. It was viewed as a red flag. The news sent shares in gaming firms like Tencent and NetEase sharply lower as the industry braced itself for tough new curbs. To no one's surprise, later the same month, authorities unveiled plans to further clamp down on the country's young gamers and impose tighter regulations on gaming platforms. Under 18s were told that they would be allowed to play only for an hour on Fridays, weekends, and holidays, and that gaming would only be allowed between 8 p.m. to 9 p.m. The new regulations mean that it will be up to the gaming companies to prevent children from breaking the rules, while authorities have said they will increase their scrutiny of the firms to ensure the limits are enforced. If all of this sounds like the Chinese government must be running out of businesses to hit with new rules, Beijing has signaled that the crackdowns will continue for years to come. Just last month, it published a new 10-point plan, which runs to the end of 2025, outlining tighter regulation of much of the economy. What is not yet clear is just how radically these new rules and much stricter enforcement of existing ones will reshape the world's second-largest economy. The outcome of that is likely to have major ramifications for all of us, whether we live in China or not. Next up, China's richest lose $35 billion following Xi's reshuffle. China's billionaires saw their assets evaporate on October 24th as the stock market reacted to the Chinese Communist Party's leadership reshuffle. According to Bloomberg Billionaires Index, Wang, founder of the Chinese e-commerce company Pinduoduo, is the biggest loser, dropping about $5.1 billion. Pinduoduo's stock price fell by 24.6% on the U.S. stock exchange that day, leaving his fortune shrinking sharply. This was followed by Tencent Holdings founder Ma Huateng, with a net loss of about $2.5 billion as shares of his companies tumbled. China's richest man, Zhong Shanshan's net worth shrank by $2.1 billion. He is now chairman and founder of bottled water giant Nongfu Spring. Ding Lei, the founder of internet and game company NetEase, lost about $1.8 billion, and Alibaba founder Ma lost $1 billion. According to Jun Eng, the market sell-off swept away $35 billion from the fortunes of China's billionaires in one day. The reshuffle of the Chinese Communist Party's leadership concluded over the weekend, with the Politburo Standing Committee filled with close aides of Chinese leader Xi Jinping, who will serve a third term as General Secretary. According to Bloomberg, China and Hong Kong stock markets fell sharply on concerns that authorities would continue to control private enterprises, and there would be no change in their strict zero-COVID policy. An index tracking the nation's shares listed in Hong Kong tumbled more than after any Communist Party Congress since the index's inception in 1994. Even before the slump on October 24th, China's wealthiest were on track for their worst year in a decade. As of October 21st, there were 76 Chinese billionaires with total assets of $783 billion in Bloomberg's Wealth Index, compared with 79 billionaires with a $1.1 trillion net worth at the end of last year. In an interview on CNBC, a billionaire investor warned that China is headed for a Mao-type economy. He further stated that investors should be cautious about Chinese stocks. Chinese chipmaker Yangtze Memory Technologies Corporation has asked all of its U.S. employees working in core tech positions in China to leave. The reason given is that the company is having trouble meeting U.S. export control. Yangtze Memory Technologies Corporation is a Chinese state-owned semiconductor manufacturer. The firm is a subsidiary of Tsinghua Unigroup, which in turn is majority-owned by Tsinghua Holdings, one of the country's largest technology conglomerates. People familiar with the matter told the Financial Times that several employees have already left the country, including U.S. citizens and green card holders. That concludes today's video. If you found the video helpful, please do consider giving us a thumbs up, and don't forget to share the video with your friends and family. Thanks for watching, and we'll see you next time.